Imagine you're looking at a stock that is up like 70% this year.
Right.
It's trading near an all-time high. And basically every analyst in the financial world is screaming, strong buy, because it's supposedly this incredibly undervalued asset.
Yeah, that's the dominant narrative right now.
Exactly.
Yeah.
But if you look behind the scenes, you see a completely different story. The executives running the company, the people who actually see the internal order books, they're quietly selling off tens of millions of dollars of their own shares.
Which is a massive red flag.
It is. So the question for you today is, are you looking at the AI opportunity of a lifetime? Or, are you walking straight into a massive trap?
And that is literally the defining tension in the market today. I mean, we're witnessing this fundamental disconnect between external market euphoria and internal corporate behavior.
Yeah.
And untangling that, well, it requires looking way past the headline numbers.
Which is exactly our mission today. Welcome to the Deep Dive. Today we are unpacking the financial whiplash of Micron Technology, Inc., ticker symbol MU.
It's going to be a fascinating one.
Oh, absolutely. We're going to deconstruct the anatomy of this massive recent surge, look at the underlying financials, and really figure out why the signals flashing across the market are just at war with each other.
Right.
But real quick, before we dive into all that data, here is your toll for the deep dive. Make sure to like this video, subscribe to our YouTube channel, and leave your comments and feedback below.
Definitely do that.
Yeah, it's compulsory if you want us to keep building these deep dives for you.
Yeah.
So, to start us off, I think we really need to understand the sheer scale of the financial rocket ship Micron is riding right now.
Yeah, to frame this debate properly, you have to realize this isn't some speculative startup, trading on hopes and dreams.
Right, it's not a meme stock.
Exactly. The foundation here is a mature structural behemoth that has undergone a just violent repricing over the last 12 months.
Violent repricing. I mean, that is the perfect way to put it. Let's look at the actual scope of this run.
Yeah.
Because as of the last close, on April 23rd, 2026, Micron is trading at $481.72, which is sitting just a hair below its 52-week record high of $493.62. But the context that makes this so staggering is the floor.
The 52-week low.
Yes. The 52-week low was just $72.50. I mean, this company has functionally multiplied its valuation in a single year.
It's wild.
Bringing its current market cap to a staggering $543.25 billion.
Right. And that forces us to ask, what macroeconomic shift could possibly justify a hardware manufacturer adding nearly $500 billion in value that rapidly?
$500 billion. It's just insane to even say out loud.
It is. But the market has fundamentally re-rated Micron. They went from being seen as a cyclical memory chip producer to, well, an absolutely indispensable pillar of the global artificial intelligence infrastructure.
And the underlying financials, I mean, at least on a trailing basis, they seem to actually support that narrative.
They do. The trailing numbers are massive.
Yeah, so looking at the trailing 12 months revenue, it's at $58.12 billion. Mm-hmm. Net income is sitting at $24.11 billion, and earnings per share is $21.18. But what really blew my mind is the fortress they've built on their balance sheet.
The cash position.
Right. They're currently holding $14.59 billion in cash against just $10.80 billion in total debt. I mean, they actually have more cash on hand than their entire debt load.
And that cash position is so critical when you consider the capital-intensive nature of semiconductor manufacturing.
Oh, because of the physical factories.
Exactly. Building a single modern fabrication plant costs tens of billions of dollars. So having net positive cash means Micron can self-fund its expansion, without being at the mercy of high interest rates or debt markets.
Which is a huge advantage right now.
It's massive. Add to that a gross margin of 58.44%, which is just exceptional.
Right. Nearly 60% margin on physical hardware?
Right. In physical hardware manufacturing, margins are usually razor thin because of supply chain costs and physical depreciation. Pushing a nearly 60% gross margin means Micron currently wields supreme pricing power.
Wow.
Yeah. And they even throw in a small dividend of 60 cents per year just to top it off.
Okay, so let me get this straight. We have a company with supreme pricing power, an inverted cash-to-debt ratio, massive revenue generation, and a 70% year-to-date run.
Sounds perfect.
Right. By all conventional logic, this stock should be an unstoppable force. But at the last close, it was actually down slightly, minus 1.1 8%.
Yeah.
So if the fundamentals are this strong, like a bulletproof tank running on jet fuel, why is there friction? Is the engine starting to sputter?
Well, the drag isn't coming from the balance sheet. The drag is coming from a glaring discrepancy in market participation. We are basically seeing a fierce push and pull between two entirely different classes of investors.
Ah, okay. You're talking about the institutions versus the insiders.
Exactly. On the buy side, the institutional order flow is just relentless.
Big money.
Big money. Wall Street funds, passive ETFs, algorithmic momentum traders, they are exerting massive buy pressure. That is the engine of the current rally.
Right.
And to add fuel to that fire, short interest is virtually non-existent. Only 2.79% of the float is currently being shorted.
Wait, 2.79%. So almost nobody is willing to publicly bet against this momentum.
Nobody wants to step in front of that freight train.
But then, you look at the insider sentiment, the people actually running the company day to day, and it is aggressively bearish.
It really is.
Over the last few weeks, Micron executives have been actively liquidating their positions right into this buying frenzy.
And the numbers on this are wild.
Yeah, let me pull these up because it's crazy. On April 10th, Executive Vice President Sumit Sadana sold $10.1 million worth of stock at $421.35 a share. And then on April 1st, another EVP, April Arnzen, sold $13.9 million at around $347 a share.
Yeah, and it's not just the vice presidents.
No.
CEO Sanjay Mehrotra has a continuous selling pattern dating back to late 2025. I mean, he was moving tens of thousands of shares even back in the $230 range.
Okay, let's unpack this.
Yeah.
Because if I'm on a rocket ship, right,
Yeah.
and I see the captain and the flight crew suddenly putting on parachutes, I'm going to panic.
Naturally.
There's that common adage in finance that insiders sell for 100 reasons, like buying a house, tax obligations, diversifying. But they only buy for one reason, which is they think the price is going up.
Right, that's the old Wall Street saying.
But aggressive, synchronized selling from the C-suite during a massive parabolic rally, doesn't that suggest management believes the current valuation has fully priced in their future success?
That's certainly the fear. And this is where we have to pause and analyze intent.
Yeah.
If the insiders are cashing out because they think the stock has peaked, what on earth are the institutional buyers looking at?
Because they aren't stupid. They manage billions of dollars.
Exactly. If the guys building the chips are selling, the people buying the stock must be relying on entirely different metrics to justify the purchase.
Okay, so what are those metrics?
They are relying heavily on forward-looking technical indicators and a very specific set of analyst projections.
Okay.
The institutions are essentially trading the trend and the momentum, completely divorcing themselves from the insider sentiment.
Then let's look under the hood of that trend, because the daily indicators show this stock is in an undeniable bullish trend.
Yes, very strong.
The 50-day simple moving average is sitting at $460.18.
And that 460 level is vital.
Why is that the magic number?
Because moving averages act as psychological battlegrounds for traders. The 50-day average represents where recent late-to-the-party buyers stepped in.
Okay, so their cost basis is basically around there.
Exactly. They will aggressively defend that price line to keep their positions profitable. If it breaks below 460, it signals a major shift in short-term sentiment.
That makes sense. And then the larger safety net, the 200-day simple moving average, is way down at $414.79.
Right, so as long as it stays above those averages, the trend is technically intact.
Okay, but what about the momentum? Is the buying pressure actually sustainable, or are we looking at buyer exhaustion here?
Well, the momentum indicators suggest we are nearing a point of fatigue. If we look at the Relative Strength Index, or RSI, it's hovering between 59.4 and 62.6.
Right, and for anyone tracking this, RSI basically measures the speed and magnitude of recent price changes to evaluate if an asset is overbought or oversold.
Exactly.
A reading over 70 generally means buyers are exhausted and a pullback is imminent.
So at roughly 62, it isn't completely overheated, but it's definitely entering the warmer end of the spectrum.
Getting a little sweaty.
Yeah, exactly. Now, the MACD, which is another oscillator that measures the relationship between two moving averages to gauge momentum, it's still flashing a bullish buy signal. It's sitting between 6.95 and 11.76.
But wait, if the MACD is bullish and the RSI isn't quite in the danger zone yet, Why are the momentum oscillators showing early signs of decline? Where is the friction actually coming from?
The friction is coming from the overhead resistance levels. Think of resistance like a structural ceiling.
Okay.
The stock is currently battling resistance at $492.96, then again at $504.20, and $514.78.
So every time it tries to break out, it hits its head.
Exactly. These are price points where early buyers are looking to take profit. So as the stock climbs toward these ceilings, the sheer volume of buy orders required to push through the sell orders becomes enormous.
Oh, I see.
The momentum is declining because it takes exponentially more energy to keep climbing at this altitude.
Which brings us to the Wall Street consensus. And this is where things get genuinely absurd to me.
It's a huge spread.
It is. The general consensus rating is a strong buy or buy, right? With average 12-month price targets clustered between $464 and $481. But average targets are kind of meaningless when you look at the extremes here.
Oh, the extremes are wild.
Market beat consensus has a low target of just $155. Meanwhile, Cantor Fitzgerald is targeting an astronomical $700, a low of $155 and high of $700. That's not a target. That's throwing a dart at a wall while blindfolded. How can the listener trust analysts when the spread is that massively wide?
Well, a spread like that from 155 to 700 is incredibly rare for a $500 billion company.
It looks like a complete breakdown in valuation models. How can two major institutional analysts look at the exact same balance sheet, the exact same AI market, and come up with valuations that are hundreds of billions of dollars apart?
Because they aren't looking at the same variables.
What do you mean?
That massive spread is the physical manifestation of the central debate surrounding Micron right now. You are looking at two entirely different philosophies of how to value a cyclical tech company during an AI boom.
Ah, okay. The great debate. Undervalued AI darling versus the ultimate value trap.
Exactly.
Let's break down the $700 bull view first. The entire argument for the bulls rests on a single metric, right? The forward PE ratio, which is currently sitting at 5.18.
Yeah, just 5.18.
Now, the trailing PE is 22.74, which is pretty normal. But a forward PE of 5 essentially means that analysts expect Micron's earnings to absolutely explode over the next 12 months.
And if those earnings projections are accurate, paying $481 a share today is genuinely a bargain.
Right, because a forward PE of 5 implies you are paying only $5 today for every $1 of profit the company will make next year.
Exactly. And in the tech sector, where companies often trade at 30, 40, or even 50 times forward earnings, a multiple of 5 makes Micron look like the cheapest high-growth asset on the entire market.
That is exactly the narrative drawing in the retail buyers.
Yep.
They screen for a low forward PE, they see Micron dominating AI memory, and they think it's a total no-brainer. But let's look at the $155 bear case, because the bears completely reject that forward PE model, don't they?
They absolutely reject it. The bears rely instead on the discounted cash flow, or DCF model.
And the DCF model is inherently more conservative, right?
Much more conservative. Rather than just taking next year's optimistic earnings estimate and slapping a multiple on it, the DCF model attempts to forecast the actual free cash the business will generate over its entire lifetime.
Okay.
It then discounts that future cash back to its present value. It accounts for the time value of money and, crucially, the risk of those cash flows failing to materialize.
Okay, so what happens when you run Micron through a DCF model today?
Well, the math gets very dark for the bulls. Based on standard DCF models, the fair value of Micron is currently calculated at just $273.
$273, meaning that at $481, the stock is currently overvalued by roughly 70%.
Yes.
Okay, I think the best analogy for this is buying real estate.
How so?
It's like buying a mansion for $5 million. The bulls are telling you, look, this is actually a massive steal because next year you are guaranteed to strike oil in the backyard.
Right.
So they are pricing the house based on the oil that hasn't even been extracted yet. That's the forward PE.
I like that.
But the bears, using the DCF model, they're walking in with an architect and a structural engineer. They are doing a physical appraisal of the property today, looking at the foundation and saying, hey, there's no oil yet. The house as it stands is only worth $2 million.
That analogy captures the risk perfectly. And it really highlights why this is such a dangerous setup for the everyday retail trader.
Because they just look at the low forward PE of 5.
Exactly. If you buy the stock today, based solely on the promise of the oil, the forward PE, you are completely exposed. If the AI revenue doesn't materialize exactly as aggressively as analysts project, or if macroeconomic conditions change,
The bottom falls out.
yes,
Mhm.
the market will violently correct the stock back down to its structural DCF appraisal value of $273, or potentially even lower, trapping all those retail investors who jumped in blind.
Which brings us to the ultimate question. What actually dictates which reality wins? Do we strike oil, or does the foundation crack?
The outcome will be dictated by very specific, looming catalysts in the semiconductor industry.
Okay, let's look at the short term first.
Short term, the next few weeks will be defined by pure volatility. The stock is wrestling with that $500 psychological barrier.
Right.
Markets are driven by human psychology, and breaking a clean, round number like 500 requires intense conviction.
And what's providing that conviction right now?
The tailwind is a severe, ongoing shortage in AI memory.
Okay, but the real battleground isn't what happens next week. The real battleground is the medium to long-term outlook, which entirely revolves around high bandwidth memory, specifically their HBM3E architecture.
Yes, this is the absolute core of the AI narrative. High bandwidth memory is fundamentally different from the standard RAM you have in, like, a laptop.
Right, it's way more advanced.
It stacks memory chips vertically to create these incredibly fast, massive data highways. And as of right now, reports indicate that Micron's entire production capacity for HBM is completely sold out through the rest of this year, all of 2025, and all of 2026.
Let that sink in for a second. A company that builds physical hardware has zero inventory available to sell for the next 2.5 years because global demand has consumed their entire production pipeline.
It's unheard of.
Why is the demand specifically for this type of memory suddenly so ravenous?
It really comes down to the evolution of artificial intelligence. For the past several years, we've been in the AI training phase.
Okay.
Companies were building massive data centers and feeding them the entire internet so the AI could learn. That phase requires raw processing power, which is why companies like NVIDIA saw their valuations explode.
Right.
But we are now transitioning into the AI inference stage.
Inference meaning like the actual real-world application of the AI.
Yes.
Actually using it.
Training an AI is like writing a massive textbook. You only do it once.
Right.
But inference is when millions of people around the world start asking the textbook questions simultaneously on their phones and laptops.
Oh.
To answer those questions in real time, the AI doesn't just need processing power. It needs to retrieve massive amounts of data instantly. Inference requires a staggering amount of high bandwidth memory.
So the bull thesis is basically that inference is just beginning. As every piece of software on Earth integrates AI, the demand for Micron's memory will just be infinite, justifying that $700 price target.
Exactly.
But, we really have to address the bear case here. Here's where it gets really interesting for the listener.
Yeah.
Because everyone talks about the AI boom as if it's endless, as if it's a permanent paradigm shift.
Yeah.
But isn't the semiconductor industry famously viciously cyclical? I mean, hardware is always a boom and bust cycle, right?
It is arguably the most cyclical sector in modern technology. It operates on a massive boom and bust rhythm.
So let's walk through what that cycle actually looks like, because this is where that $155 price target starts to make terrifying sense. If HBM is sold out through 2026, what happens in 2027? Do we just hit a brick wall of oversupply? Does the music just stop?
History tells us it almost always does. Look at previous cycles, like the cryptocurrency mining boom in 2018 or the pandemic PC boom in 2022. When there is a severe shortage, chip prices skyrocket. Customers panic and double order chips to ensure their own supply chains don't freeze.
Which creates an artificially inflated order book.
Exactly.
Yeah.
And in response to this massive perceived demand, companies like Micron, Samsung, and SK Hynix spend tens of billions of dollars building new fabrication plants.
But those plants take years to build.
Yes, and by the time those new factories finally come online and start flooding the market with fresh supply, the initial frenzy has naturally cooled down.
Oh, no.
Customers realize they overordered, they cancel their backlogs, and suddenly the market is just drowning in excess memory chips.
Which triggers a brutal price crash. The 60% gross margins evaporate overnight, earnings collapse, the forward PE model completely breaks, and the stock price just plummets.
Yeah, this is a known phenomenon. It's called the bullwhip effect in supply chains. And this brings us all the way back to the start of our conversation, the insiders.
Right, the executive selling off.
Bears argue that the executives selling tens of millions of dollars of stock aren't doing it randomly. These are veterans who have navigated these exact boom and bust cycles for decades.
Yeah.
They know that when the order book is sold out for 3 years, you have likely reached peak cyclical optimism.
So the insider selling is basically them saying, look, we've reached maximum capacity. We can't physically sell any more chips until 2027, so it's time to cash out before the inevitable oversupply hits.
Precisely. And add in the looming macroeconomic risks, like the U.S. government potentially escalating export controls on advanced technology going to China.
Which is a massive consumer of memory chips.
Exactly. When you factor that in, the downside risk becomes very, very real.
Wow. So when you synthesize all of this data, the paradox of Micron becomes really clear.
It does. You have an incredibly profitable, cash-rich giant that literally holds the keys to the next phase of the artificial intelligence revolution.
Yeah.
Their technical momentum is strong, and if AI demand truly is infinite, their forward valuation is a generational bargain.
Yeah.
But the combination of aggressive insider liquidation, extremely conservative DCF appraisals, and the unavoidable cyclical history of the semiconductor industry, well, it demands intense caution.
It really is the ultimate high-stakes standoff between the charts and the fundamentals.
Definitely.
And just a reminder for you listening, we love digging into the data with you, but this is a natural human debate about the numbers and the market mechanics. This is absolutely not financial advice.
Yeah, the data provides the map, but you really have to navigate the terrain yourself.
Totally. So what does this all mean for you? I want to leave you with one final provocative thought to mull over.
Let's hear it.
The AI inference stage promises an insatiable, endless appetite for data and memory. But the unbending history of economics tells us that whenever massive profits appear, massive supply eventually follows, and that inevitably leads to a glut.
Always does.
So if you were holding a stock that was up 70%, boasting a tantalizing forward PE of 5, but holding a structural DCF fair value that is nearly half of its current price,
Yeah.
are you confidently riding the rocket to $700, or are you quietly packing your parachute alongside the CEO?